Greetings. Are you sick and tired of your federal income taxes being used for weapons that are killing people in Gaza, Iran, Yemen, and so on, but you see that your federal income taxes are already removed from your paycheck? If that's the case, you found the right video. In the United States, we actually have the option of controlling how much federal income tax is removed from each paycheck. So if you're an employee, probably your first day on the job or when you're first hired, you were given what's called a W-4 form to fill out. And this actually tells your employer how much to remove from each paycheck in federal income taxes. You can refill out this form at any time and submit it, and your employer will then update that, and you'll see a change in how much you have in your take-home pay, usually, if not your next paycheck, within about 3 weeks. Here we have the W-4 form. It's a form created by the IRS, but it actually never gets submitted to the IRS. It's just used as a tool between employers and employees. Again, you probably filled it out your first day of work or when you're first hired at a job. And in addition to your name and basic information, when you put down your filing status, that lets your employer know what your standard deduction is going to be when you file your taxes at the end of the year. So if you're single or married filing jointly, your standard deduction is going to be $15,000 for tax year 2025. If you're married filing jointly, your standard deduction is going to be $30,000 this year. And if you're head of household, your standard deduction this year is $22,500. So what this lets your employer know, or their software that handles their payroll or their payroll company know, is that if during the year if you're single and you're going to make $15,000 or less, they already know that with your standard deduction, you'll have zero taxable income, and therefore they shouldn't, except in specific situations, they shouldn't be taking any money out of your paycheck. But what if you're making more than the standard deduction for your filing status? So let's look at a situation where you know you make $15 an hour. The next question you need to know, or the next thing you need to know, is how often you get paid and what's the most you would work during a pay period. So let's say you know you get paid every 2 weeks. That means during the course of a year, there's 26 pay periods. And you already know you make $15 an hour. And let's say during a 2-week period, the most hours you would work is 80 hours. So the most hours you would work during a pay period. The reason I bring that up is if your hours are varied and you want to zero out your federal income tax withholding, you need to make sure that you put the maximum amount of hours that you would work. If your hours are steady, then this is less of a concern to figure out. You already know how many hours you work per pay period. So now you can figure out how much you make in a given year. That would be 26 pay periods, $15 an hour, times 80 hours per pay period. Your pay for the year is $31,200. So even though you don't put this down on your W-4 form, your employer already knows when they're processing payroll, this is what you'd make during the year if you're going to work the entire year. And so this is the number you'd want to have in mind, even if you're only working at a place for half the year. Maybe you're starting in July and only working there through December. The computer, their software will assume that you've been working at the same pay rate and hours for the whole year. So you want to keep the whole year in mind. So again, $31,200 in this instance. So the computer, again, now knows you make $31,200 a year. If you're single, it believes that your standard deduction is going to be $15,000. And if you don't do anything else to your form, we can see as we go down here, the number to put on deductions 4B. So this is a line towards the bottom of the W-4 form. And again, this is what the computer's doing when it's figuring out how much to remove in federal income taxes. It's taking your total yearly income of $31,200 minus your standard deduction as a single person, which is $15,000. And then that equals what it believes your taxable income will be for the year, which is $16,200. So now based on that number, the computer knows how much you'll owe in federal income taxes. And if you do nothing else, it'll remove a certain amount of money from your paycheck, send it to the Treasury Department based on this being your taxable income. But if you want to zero out that amount and tell the computer not to remove anything from your paycheck, this $16,200, which would be your taxable income, is the amount you want to put on line 4B for deductions. So again, we go back to the W-4 form. If we go down to line 4B, which if we go over here, we can see this is step 4, adjustments. B is for deductions. So legally, they're asking what type of deductions do you expect to claim on your taxes at the end of the year. If you want to zero out your taxable income from the computer's end, you'll put down that $16,200. And again, now the computer is going to say $31,200 is your total income for the year. $15,000 is your standard deduction. Now, if you had added, if instead of equals, if this said subtracting also $16,200, it would mean your taxable income for the year is $0, and your employer would remove no federal income taxes from your paycheck. Now, if you're thinking about doing this, I'd highly recommend going to our website, which you can find the link to in our bio, but it's nwtrcc.org, nwtrcc.org, and you can see based on different situations what your risk is, what potential consequences are. We want to make sure that people go into this practice with their eyes wide open. But essentially, this practice of W-4 resistance is a way to make sure that when April 15th comes next year, you'll actually owe federal income taxes that you haven't paid yet, and it gives you the option if you want to pay them or not. So it's meant as an empowerment tool. Also, to give full transparency, this if you're not expected to actually have those deductions and you expect to owe federal income taxes, this is what's known as inflating your W-4 form. It is illegal. According to the law, you could face up to 1 year in prison and a $25,000 fine. But it's not something that the IRS has actually prosecuted people for since 1975. When this practice of inflating income taxes to avoid paying federal income taxes for the Vietnam War became popular in the late 60s and early 70s, the IRS prosecuted 5 of the more prominent war tax resistors who were promoting this mode of avoiding federal income taxes and avoiding paying for war. And they each did about 9 months in prison. But at that time, the IRS discovered this only raised awareness of how to inflate your W-4 form, and they decided to put more focus on trying to collect taxes through maybe levying a bank account, garnishing your wages. So those are possibilities that could also happen to you depending on your situation, though the IRS hasn't been very good at doing this recently. They've already been low on workers. Trump is currently gutting the IRS further. But it's, again, I'd recommend going to our website. We have an introduction video, which will kind of go through the whole gambit of everything that's included with war tax resistance, what could happen, what's likely to happen, etc. So I recommend you check out our resources. All of our resources that we create are on our website and available for free. We're just here to be a resource to help empower people so that if they, in their conscience, they believe that what the U.S. is doing with its weapons and military bases and militarism and militarizing of police, etc., 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 you now have the power to stop doing that. So again, thank you for watching this video and considering war tax resistance.